Well, hello and welcome to this special show we are calling 2016 the Year of Growth. It is ironical that we have this discussion on the potential revival in global growth at a time when the world is grappling with the Brexit vote and its implications. The only question that investors, economists, and policymakers across the world are asking is when and how will economic growth pick up in a meaningful, sustained manner. Today, we are joined by four experts to make sense of the global macro situation and its influence on markets. Joining me today on the show are Rakesh Shah, Chairman and CEO, Edelweiss Group, Nilesh, CEO, Kotak AMC, Pranjul Bhandari, Chief India Economist, HSBC Securities, and Jeetu Punjabi, noted global strategist and investor. Thanks very much, all of you, for taking out the time to speak with us. Now, before I just start off the discussion, I want to highlight an interesting observation. The IMF, the World Bank, over the last 8 quarters, that is the last 2 years, have successively lowered their forecasts on global growth. And that's been the case with all major central banks in the world who've been very cautious about their growth outlook going forward. But the markets this year, from a year-to-date perspective, have been very, very resilient. Despite China, despite Brexit, look at the Dow Jones. It's actually done a positive return year-to-date. That's pretty much the case with the FTSE as well in local currency terms. After the Brexit vote, interestingly, the FTSE actually made a fresh 2016 high. CAC DAX have been under pressure. They've had problems of their own. But even for some of the Asian markets, you have India, Indonesia, Thailand, Taiwan, which have done really well. Russia and Brazil have been a known story as well. So that's the key imponderable, something to wonder about, why the market's so resilient if the underlying growth fundamentals are looking weak. And Jeetu, let me start off with you. You believe that part of the answer lies in looking at growth for 2016 in nominal terms. Explain that.
Okay, so a lot of conventional frameworks looks at GDP growth in real terms and tries to link that to markets. And what happened last year was very unusual and was similar to what happened in 2009. So what really happened was the world shrunk by $5 trillion. The world was $78 trillion at the end of 2014. At the end of last year, it was $73 trillion. Why did this happen? The world grew at 3.1%, as IMF quotes. The factor is that there were two factors to it. One was the deflator, and the second was the dollar rally. If you see countries, Brazil shrunk by 26%, Russia shrunk by 35%, Japan shrunk by 10%. What was the combined fall in the value of these economies in dollar terms? $5 trillion. Now, as you saw the world economy shrink, you saw profit pools shrink. As you saw profit pools shrink, you saw markets react to it. Why did this happen? China. Miscommunication and market mismanagement. Sure. And that was a cyclical factor. That bottomed in February. As commodities bottomed and turned, you saw things turn. And my view is that this year, the economy probably expands by $5 trillion. As the economy expands. And
that takes the nominal GDP growth up by 7%, which is a good swing of 13% from the low last year.
Absolutely, absolutely. And as we go back to a $78 trillion economy, markets normalize. So what markets today are telling you is similar to what I'm saying, whereas what most of the street is telling you in terms of nervousness is the fact that is a linkage to the real GDP world.
Rashid, do you think that the markets globally are pricing in this sort of a turnaround in nominal GDP? So you have the dollar retracing a bit, stabilizing, but the commodity bounce back. The deflation worries have eased a bit, which will add to the overall numbers this year.
Yes, though I think even now deflation remains a problem. And in fact, the key change that has happened in the context, because in India all of us are always worried about inflation. But the problem in the world at large now is not inflation, but the opposite of inflation, deflation. So the moment commodity prices come back, the US dollar weakens, they're all correlated because a strong dollar means the world is deflating usually. So when the US dollar has weakened a little bit, commodity prices have gone up, all of that when you add up, it means that good inflation is coming back, because historically there have been two kinds of inflation. When the supply constraint is there, when demand constraint is there. Demand constraint inflation is what we have now.
Yeah.
The global aggregate demand has been falling and it's not reviving at all. And we are seeing maybe a small subset of that in India also. But historically we have always seen inflation in the context of supply constraint, and that's why in the 80s we had supply side economics and making it easier and deregulation and all. So, and that was the bad inflation. So I think what is happening now is the world is looking for good inflation, which would mean that the demand is reviving. And the commodity prices coming back up, the nominal GDP being higher than the real GDP growth rate. If you remember, we had the same problem in India last year.
Yeah.
The nominal GDP and the real GDP for, I think, after a long time were the same. And it also affected because you feel that there is no growth.
Yeah.
But if the Indian inflation remains about 4 to 5% and the economy is growing between 7.5 to 8,
Sure.
then you will have a nominal GDP which is higher. So this will affect sentiment. It will affect even liquidity. And both sentiment and liquidity will drive, though as you very correctly said, earnings is not there. But markets are driven by sentiment, liquidity and earnings. So earnings is what is still holding back the market. That's why we have this start and stop kind of a approach to markets.
Yeah.
But liquidity is so strong that it's unlikely that markets will correct, but they will keep on getting stronger.
Nilesh, how do you look at the story? Is it really about, how the markets perceive nominal GDP for the year versus real GDP, which is, a reflection of the core economic activity, versus, what's happening in the commodity prices?
I think what we need to focus is the purchasing power parity GDP. When we try to measure everything in US dollar terms, we are seeing everything from US investors' point of view. In the world, US investor is in a minority. There is a far bigger population of non-US investors.
Yeah.
Did the world produce lesser goods compared to last year? No. It produced more goods. Did it consume less services compared to last year? No. It consumed more services. So while on a top-down basis, it does feel that the global real GDP growth is not getting converted into nominal GDP growth. For a country like India, for a fund manager like us, we need to focus probably on purchasing power parity GDP. There is more growth in terms of volume of production, there's more growth in terms of consumption of services, and as long as you are in that segment, you will make money.
Right. But, the other aspect to this discussion which came out was the fact that the world can't afford a very strong dollar, because a large part of this pickup in nominal GDP, the bounce back in commodity prices, also comes in on the fact that the dollar has retraced quite a bit. Come in on that, Pranjul. How do you look at the dollar trade now and what it really means for the world?
Actually, just taking a step back, I wanted to just respond on this whole nominal and real GDP mix. Look, the world has a demand problem. Globally, private investment is weak, export trade is weak. The only one, shining star has been consumption demand, and that was, doing a good job. We were seeing consumption revival in the US and in the UK until this entire Brexit thing happened. We don't yet know, how the rest of the year will look on the political front, but it's possible that there could be some renewed uncertainty that could weigh on consumer sentiments. And if that happens, then the consumer demand story would become a little more sluggish than it was in the first half of the year. Now, keeping that in mind, as I mentioned, it's a demand problem, and the unique characteristic of a demand shock is that demand, output and prices move in the same direction. So if, output falls, then prices also fall, and that's exactly what we're seeing all around the world, that inflation is much below, long-term trend. So, growth is below long-term trend, inflation is below long-term trend, and they move together. Now, what policymakers are trying to do is they're trying to stimulate the economies in terms of, monetary policy stimulus, fiscal policy stimulus. Some cases they have succeeded a little bit, some cases they haven't succeeded too much. But the point here is that if they do succeed and growth goes back up because of a demand stimulus, then prices will also go up. So in that sense, real GDP and nominal GDP are likely to move in step. They went down together, they are likely to rise together as well. Now, there could be 1 or 2 quarters in which we could see real GDP being stagnant but nominal GDP being higher, and that would be mostly driven by the GDP deflator gaining on a low base. So, oil this year is $60 and last year was $50, so there's a year-on-year increase. So we could have 1 or 2 odd quarters where nominal growth will be higher than real growth, but this will probably not be sustainable. Because we are not
That's
really
an important point, actually. Yeah,
increase.
so we talk about the dollar trade in a bit, but just sustainability of this thesis, Jeetu, how do you really expand this thesis into 2017, unless you're working with the premise that, commodities, this commodity rally is structural in nature, not just cyclical. It's not just covering ground for the ground lost last year, but also the fact that, in a meaningful way, demand is coming back, because the oversupply problem is still there in the commodity world.
So I completely agree with Pranjul that this is a short-term phenomena, and the fact that we make in the note also, there's a short-term phenomena, but there's a reflexivity to it driven by a couple of factors. One, at $27 oil, the profit pool for the entire energy industry was negative. Right? You come back to $50 oil, the profit pool expands. The energy industry hires people, and there's a reflexivity from profit pools to hiring to economic activity. And I think that's the point we're trying to make, that we went to an extraordinary weak point between December and February this year. We're correcting and normalizing towards the end of this year due to the reasons we say. And as we do that, we'll find a more normal economy. The point, I think it's a fair point to say that we're on a low growth trajectory going forward. But having said that, US has been growing at 2 to 3%. A lot of other parts of the world have been growing at low rates, but the markets have been fine. So I don't think economic activity or levels of growth are directly relevant to market performances. I think what's the level of ROEs you generate, and thus how do markets do?
The other aspect where there would be some circumspection or skepticism about this theory would be what happens in the fallout of the Brexit vote. How does the UK economy or Europe adjust to this breakup over the course of the next 6 months? And Pranjul, you want to comment on that, because that will just derail the process. I mean, yes, we're talking about a certain premium coming in on the back of the FX as well as the deflator bouncing back. But at the core level, real GDP also, I mean, that's economic activity, right? That's productivity being measured in terms of the total produce going out. And what happens to that? Because those numbers will get revised lower. So who knows, we might not end up this year with a 3% mark that the IMF is projecting on real GDP for the world.
Right. So I guess, Brexit is just one event. We don't even know how the fallout will be. Will it be a hard exit? Will it be a soft exit? But there are many other political events also coming up. So for instance, Italy has a constitutional referendum in September. US goes into election mode in October. Next year, both France and Germany are in election mode. And through this whole period, there are going to be many European Union meetings across the entire European Union. So there are a lot of political events that are going to happen. And really, when there is some sort of uncertainty in the world, then it does weigh in on consumer and business sentiments, and it does weigh in on consumer demand, and it does weigh in on private investment demand. So to that extent, private investment was already in the funk, around the world. New investment intentions anywhere, emerging markets, advanced markets, are very dull at this point. To the extent we will now have more political uncertainty, around a big area of the world, I think private investment could remain further, for a longer period. And coming back to a point you were saying, what about 2017? I think this will weigh in on 2017. A lot of people who have their growth projections across the world rising quite considerably in 2017 will now have to, take a step back and see, are sentiments buoyant enough to be able to, support this sort of revival around the world?
Yeah.
In terms of policy stimulus, we have a few. We can't really work with sentiments. Policymakers can't change sentiments, but they can do a lot in monetary policy, fiscal policy. Monetary policy, the world has tried everything, low interest rates going to negative, quantitative easing, the talk about helicopter money, which we were also discussing earlier. So we've tried all sorts of things, but I think the very big thing which we're likely to see this year and next year is much more fiscal spending. Even countries like UK, which work with, difficult fiscal targets, once they say that growth is likely to be lower than 1%, in the UK, which we think it will be next year, room opens up and they are allowed to do much more fiscal spending than before. In fact, our calculations show that in 2016, fiscal spending around the world will probably be the highest, that we've seen in the last decade or so. So I think this is going to, last few years we've been trying out on monetary policy. From this year onwards, we're going to try out on fiscal policy, and let's see where that takes us.
Mohammad El-Arian, post the Brexit vote, gave us his comments, and he said that quote will just come up for our viewers, that central banks across the world have run out of bullets. They have really low, very, very low interest rates, and balance sheets have already been expanded quite a bit. So if the financial disruption continues, this will impact global GDP and will make the chance of recession in Europe as well as the UK higher. Rakesh, how do you look into the market's resilience then? As we'll come to China and the risk coming in from there, but just given the growth outlook that there is, because that's really holding the key to market sentiment going forward. Plus the fact that yes, central banks will be accommodative, but how long can they be accommodative, and how much does that really stimulate market sentiment going forward?
See, how long is a hard one to answer, because we already in, as
8 years. Yeah.
it's been uncharted territory, because I think we are rewriting the economics textbook in real time. And if you go back, 80 years ago, 90 years ago, when the world had recession, and then Keynes came about and came with a new theory of about government spending and fiscal spending as a counter-cyclical force. I think we are somewhere in the same way, but though Keynes was about fiscal, now it is about monetary stimulus to create demand, because I think structurally, as a large part of the world population is aging, demand is going down. Technology is also creating a huge deflation, because technology is bringing down cost significantly year after year. Technology is unlocking a lot of unused capacity, spare capacity, whether you look at Uber, the Uberization of the world, or the Airbnbs, and also there is so much capacity which was unutilized is coming on stream just because of technology. So technology, aging population, all of that has ensured, and I think will continue to ensure, that the global demand remains weak. We can say China, we can say Europe, we can say Brexit, but all these are symptoms of an underlying trend, which is that how do you get global demand back? The only good, the silver lining in all this for India is that all these problems are exactly opposite of India's problem. India's problem has been inflation up till now. And if the world is deflating, because the way we used to import inflation, via all the tradables, we are now importing deflation. As oil price goes up, we import deflation, which is in a way helping us manage the inflationary pressure that our economy always had. The same way, the global population is aging, but Indian population is not aging. So given all of this, there is a good, I think India does present a very counter view of the world, and India's problem are being solved by the world now. So the world problem, so we should be very clear, we should segregate the problems in the world, which is, deflation, lack of demand, aging population. India is exactly opposite of that. And all these were our problems. Inflation, consumption, demand, all of that. So the world is actually helping us. And that is why the moment Brexit happens, everybody said global growth will slow down, monetary easing will happen, good for India, because oil price will come down, good for India. Liquidity will happen because we import capital, we import oil. So both, if the cost of capital comes down, cost of oil comes down, it is good for India. So India is going to be one of the few beneficiaries of this entire global trend that has been going on for the last 5-7 years. We obviously have to get our act in place, which fortunately in the last couple of years with the new government, the ease of doing business and trying to make it easier to take advantage of these global trends which are happening. And I think that is why India looks so positive for Indians as well as for the global investors, because we are one very, very, I would say, a very idiosyncratic economy, which is very different from the world at this point, and we will benefit out of all of this.
Let's talk about the big risk that was pretty much worrying the markets at the start of this year, which was China. How does that risk now stack up? Because the yuan is getting devalued against the dollar, but the markets are not reacting to it as they did at the start of the year. You still have slowdown concerns in China, but the market's reaction is more measured.
So I think the way to think about China was they started in August with the accession to the SDR and made an adjustment to the renminbi, and they did not communicate. Markets were worried what is happening. They did not know what is happening. As you went through December, Jan and Feb, you saw the cyclical concerns worsen. I think what's happening in the last couple of months is that the second derivative of change is positive, which really means that markets have accepted that this is the new normal for China. Markets are not worried about a cyclical collapse from here, and markets think that China will find a way out of this chaos. Now remember, the investment slowdown in China started something like 5-6 years ago. So it's not, it started today. And the second is the communication levels have gone up on the margin, just a very little bit. So I think China will keep slowing down, keep muddling along. There'll be challenges. There are political challenges as well on the China horizon that they're trying to figure out. And so I would not view China as a brand new concern. It's an existing concern. It's going to stay. And I don't think there are fresh salvos coming out of China immediately.
Actually, if I may just add to that, I think China is also part of this overall trend. So 8 years ago, US was a problem, then Europe became a problem, and we had, Greece and Dubai and
Moving
Cyprus.
from the west to the east.
And Cyprus and, one after the other. Now it's China, but this is now the way the world is going to be. Every 5-6 months, there'll be some episode that will happen in the world. It will be Brexit, it might be Italian election, it may be US election, it may be something else. The world will get scared, there'll be huge amount of volatility, it will go away, there'll be injection of capital, one new steroid will come in and markets will revive. Because there is, as I said earlier, if the underlying demand is not there, growth is not there, all the central bankers are trying very hard to make sure that things don't get worse. So even if they are not improving, they are at least ensuring it's not get worse. And I, for one, I'm in a minority, I feel the central bankers have done a great job. Otherwise, in the last 8 years, we may have had repeat of the 1930s recession. So we avoided that recession with this huge amount of unprecedented monetary stimulus that has gone on, and I believe that it will continue because the underlying problem is not solved, and I don't know how the underlying problem is going to get solved, because as long as technology is there, jobs will get lost, demand will get affected, so that goes on. So it will be China for the next maybe a couple of years, then it will be something else. It might be Australia one day, it may be something else. But the world will just go into these phases, and I think we all as investors have to now, have to adapt ourselves to this and not get too shaken out of this, what I call periodic return of volatility and the world, the global worry about some event or the other.
Actually, I just want to bring in Joachim Feld's quote. He's a chief economic advisor at PIMCO, and he says that it does not take much to derail an expansion that is already bumpy, below par and brittle, the BBB expansion as he calls it. In fact, one reason for confidence, according to him, is that typically recessions happen if there's a combination of excessive consumption or investment overheating or monetary overkill by the central bank. That's when recessions essentially happen. And he's quite confident the recession probability is very low, even though we're going to see low growth for a really long time. Nilesh, you want to comment on that?
Yeah. When my recommendation is that whatever you are in deficiency, you open up your economy for that. Today, US, Europe, many parts of Japan are in deficiency from a demand point of view. If Japanese population is going down, there is no way in the world they are going to consume more.
That's true.
So you have to open up your economy for labor migration. India has a lot of surplus labor. Please pick them. Import them into your country like you have advised us to open our economy for your capital. Yeah. You have surplus capital, that's why you tell us to open our economy for capital. We have surplus labor. Please open up your economy for surplus labor and then see how the demand grows. Yeah. Let those Indians migrated into Japan, US and Europe have the same standard of living as your economy, as your citizens, and see the growth.
That's true. You would not be very happy listening to that in the UK as well right now.
Actually,
but yeah, that's a fair point.
All over the world, it has shown that immigration actually does boost demand and economic growth. But immigration also has this other psychological, emotional issues around that. In fact, the entire Brexit issue was around immigration, and Germany realized that the more immigration that happens into Europe, the better it is going to be for the European economy. Yeah. And if it is better for the European economy, it is good for Germany. Right. But I think this answer is going to be, there are going to be so many emotional issues around that that is not going to be easy answer, but maybe this will be the answer to handle the lack of global growth.
Pranjul, I just want to come to you with this, as a reaction to this, another quote by Harvard Marx of Oak Tree Capital, who we spoke to on 4th Feb of this year. And he said, just extending your point out, Nilesh, in much of the world, birth rate has declined and the rate of increase in productivity has declined. And these two things together are the primary gross determinants of growth in GDP. So it appears to him that we are likely to be in a low growth environment in the next 10 to 20 years.
Well, yeah, so, you've had people like Larry Summers talking about secular stagnation, in which he's touched about things like demographics as well. But, if we want to really talk about one indicator of growth, which is a way to evaluate whether all the stimulus which the countries are providing, is it going in the right direction, is private investment. Is private investment, picking up anywhere in the world, sustainably? And so far, even after all these years of, loose monetary policy, we don't really have private investment picking back up. And that's because the world, as I said, has a demand problem. If already all your companies, all your capacity is working in slack, there's too much of overcapacity, why should you go out there and build another firm? Now, really, all the stimulus that we are giving at this point is to crowd in private investment. And one way that could could happen is that, consumption demand, which is doing fairly well around the world right now, that continues to do well, sustains over the next 1 or 2 years, and is able to responsibly, without becoming inflationary, is able to close the excess capacity, close the slack across many sectors, and over a medium term crowd in private investment. That's probably our best hope for growth at this point. But at every level, it will need a helping hand. It will need a helping hand of good sentiments. It will need a helping hand of good public policy. And here we are now seeing a lot of fiscal policy that is coming up. Governments trying to spend much more than before, giving much more tax cuts in selective countries, much more than before. I think it's a good experiment to do, at a time when the world does not have any other support. But I'm also worried that there is more uncertainty here than certainty. It's quite possible that the spending that the government does is not productivity enhancing, is not investment enhancing, in which case it will just, fuse off, the moment it's done. It won't really build capacity of the economy. It won't create jobs. It won't, bring in higher wages and so on. So I think the fiscal stimulus is a great idea at this point, but we have to do it much more responsibly than even before.
Yeah, and
if I can come back on this, we should encourage German EU model. So Germany provided financing to rest of the European Union countries in order so that they can buy German goods.
Yeah.
Now we are talking about Brexit. Britain was probably the first country where steel making and commercial coal mining started. All the steel which they have produced till today, China makes it in 1 year. So we need a financing model like German in EU, where the world can give its finance to India to consume. In 1 year, we'll consume more steel than what Britons have consumed over centuries.
That's true. No.
So give the financing, we'll take everything.
Real GDP, we've talked about the bounce back in nominal GDP, commodities, etc. Real GDP, which is a measure of core economic activity, and where we've all agreed upon the fact that there is a need to push demand. How does that problem get resolved? Because yes, there's going to be fiscal policy, there's going to be more public spending. There is, of course, QE, accommodative policy, monetary policy from the central banks, helicopter money, all of that is there. But private investment, there's so much talk about every soundbite that, you hear from policymakers. You're like, we need to push private investment, not just in India, but across the world. Private investment is at a low. What spurs private investment, and why is there so much focus on private investment when, demand can be pushed in other ways?
So my view here is that private investment is always a lagging indicator to the economic cycle. I think it's the wrong question to be asking. I think the question is, if you see what happens, if you see the question, I think, let's take the bigger question that was just brought up, right? Why are things weak? What's going to take us out of this mess? I think this is a classic question you ask in the bottom of a cycle. And it's normally a 7-year cycle, and you keep asking, how are we going to get out of this? Is there a ray of light? Who's going to drive this cycle? Why is credit growth so weak? Why is investment so weak? In my view, credit growth is a lagging indicator. Private investment is a lagging indicator. Employment is a lagging indicator. Early side indicators are when you see fiscal spending take off, you see monetary side stuff moving, and you see public spending in a significant way. And we're seeing, let's take India, we're seeing public investment happening. Now, we're going to see private investment happening in a hurry? I don't think so. It's going to take a year or two. You're going to see capacity utilizations get higher, and then you see private sector capex happen. Similarly, you're going to see people using their capital before they go and borrow. So credit growth too will lag the cycle. And I don't think we should be asking that question at this point. I think we should just be looking at what is driving the cycle today, what are the economic indicators driving the cycle today, and what is the roadmap from here to for the next couple of years as this cycle moves on.
Rashesh, do you agree to that? That there's too much focus on private investment, the government is spending enough, and not just in India, world over. You have support coming in from the central bank, and that should do the work. Also, there's a lot of underutilization in capacity. I mean, we've seen WPI be for 13 months in negative territory. Now, of course, it's bounced back. So till that clears out, there is no need for companies to actually go ahead and, why would they expand capacities? Why would they invest more when their current capacities are not taking off?
True. If you see, I think India, the private investment will come back when the demand pickup happens, because we still have overcapacity. So I think all of us agree that first it will be government spending, and it started in railways and defense and all of that. But eventually, I think given that there is strong consumption demand in India on a structural basis, I think private investment in India will come back. Will private investment globally come back? I think unlikely, because there is so much overcapacity already there globally, and out there consumption is not coming back. So I think in India, I would expect in about a year's time we should start seeing private investment. We're already seeing it in a few areas, like at least we have seen it in the roads coming back. In renewable energy, a lot of investments are happening in India already. We're starting to see an early sign of some pickup of investment activity on the private side in railways now. So railways and freight corridors and logistics, a little bit of investment is starting to creep back. We'll see, defense will be a huge investment sector for India going forward. So India, I'm fairly confident that the private investment will come back. Currently, a few corporate groups, the balance sheets are stretched and all, but all that will get corrected in the next couple of years. But globally, as I said, I think we are caught in this rut, which is now, in a way, it's a self-fulfilling trend, which goes on and on. And as I said, as long as that trend goes on in the world, India is a big beneficiary. We should all be happy. So every time China slows down, even though in the short term there is this flight of capital because of oil fall and all that, in the long term basis, very good for India. If oil ever goes to $20, it is very good for India. Yeah. We should all be confident. We should not really worry about what happens in the short term, because on the long term, India will benefit out of this.
Right, Nilesh, the other aspect, unless you have an extension to that point, the other aspect is this obsession with export growth, contributing to any country's GDP, and having a lower currency to help that. Do you think that's a bit overdone? Countries should now be looking inwards. I mean, UK is a classic example. They want to build consumption in their own country. US wants to build consumption in its own country. But at the same time, they don't want to have a very strong currency. They want to have weaker currency because that just gives, some sort of momentum to their potential to export.
See, you could get away with beggar thy neighbor policy of weakening currency in the 90s. China got away with it by massive depreciation of renminbi. But when they tried doing this time, everyone depreciated more than China, giving zero advantage to China. Other than US dollar, most currencies have depreciated against Chinese renminbi, giving no advantage to them through currency depreciation for increasing their exports. So my guess is that sooner or later world will realize that you can't continue to have depreciated currency and grab export market share. If we see US presidential election, one of the presidential nominee is saying that China is a currency manipulator, and if he becomes president, he wouldn't mind, putting some sanctions on them.
Yeah.
So I don't think so the route of currency depreciation is available. For us, fortunately, we really don't have to worry about that. We should focus simply on growing our economy.
Yeah.
For example, we were importing $17 billion of coal, not because we didn't have coal in the ground, but because we didn't have policies which allowed that coal to be mined. Today we are doing that. Our import bill has fallen from $17 to $13 billion. Instead of creating jobs in Mozambique and South Africa and Australia and Indonesia, we are creating jobs in Jharkhand and Chhattisgarh and Orissa and West Bengal. So we can still grow leveraging our domestic economy, leveraging our domestic resources. Not that we should be disconnected with the world. Surely we should keep one eye over there, but our far more focus needs to be domestic.
Right. And
the only thing I would add, Nilesh, don't you think that currencies falling is inevitable, because low interest rates and monetary easing in every country will ensure that currencies keep on falling. So in a way that is inevitable as long as all this continues. Yeah. Alongside that, in India, I don't think we should look at currency depreciation, let us say vis-a-vis the rupee also, only from an export point of view. We also look at it from the import point of view, because a strong currency also makes imports a lot more attractive.
That's right.
And I think in India, that is the larger problem we have to worry about, because the local competitiveness goes away vis-a-vis imports. If the rupee were to fall by another 10%, and I am one of the advocates who feels it should fall, then a lot of your steel companies in India will become viable. Yeah. Again, because then you won't need MIP and all of that. So if there is monetary easing and low interest rate and negative interest rate in the world, currencies will fall. If they will fall, somewhere India will have to move in tandem. Otherwise, we'll keep on getting more overvalued and uncompetitive, not for exports, but for imports.
The currency expert, please come in.
I just wanted to spill some water in a bit of the positive talk. I know there is we all think India is a shining star in the global stage and all of that, but we have unique problems, and we have a huge problem in our hand, which is how do we create jobs? Now in the next decade, we need to create 80 million jobs. In the last decade, we needed to create about 50 million jobs. So the problem is almost double for the next decade. The only country which has had to create jobs in such a large scale has been China over the last 20-30 years. But remember, they had two taps open. One was external demand, the other was domestic demand. External demand was doing so well that they built all the capacity at home. They sold things to UK, Europe, America, and on the back of that, they created jobs at home. We probably don't have that external demand tap at this point because global demand is weak, likely to remain sluggish for a pretty long time. And this time the jobs that we create, the 80 million jobs that we create, have to have a domestic source. Where is this jobs going to come from? People are leaving agriculture. 20 years back, agriculture used to employ 60% of Indians. Now it's come down to 45% of Indians. People are leaving agriculture. Very few farmers' children want to be farmers. They want to work in the offices. So our manufacturing and services being able to create these jobs. Think about it one at a time. Manufacturing will be able to create this kind of jobs if today we become as efficient as China, because manufacturing goods are tradables. China is selling, they have a lot of capacity there. Manufacturing in India will only rise sustainably if we can become as efficient as China. We could, but I think it's a long stretch at this point. That leaves us with services. But will services be able to create so many jobs? Will we be able to get this 80 million productive jobs over the next decade? And I think, we feel very positive about India's growth, that, if it increases from, say, 7% to 7.5 to 8. But at this point, we need much more. We need much more reforms. We need much more domestic sources of growth and productive jobs.
Very quickly, Pranjul, on the currency side, because the rupee has been so resilient, which side of the debate are you on? How do you see the currency move for the economy?
Well, 2 points here. One is that there'll always be enough people telling you that the currency is very weak, that the currency is very strong. But if you sort of mark it up with the long-term average, it seems like it's sort of fairly valued at this point. I'll probably leave it there because this debate doesn't have one correct answer. It sort of depends on who you ask. But on the other hand, does a weaker rupee really mean our exports will increase and export-driven growth will increase?
That's a perception, yeah.
And here I want to again say something which is slightly different. I've looked at this very carefully. We've seen a big export slowdown since 2011, and I really tried to drill into why were exports slowing. Now I found that currency problems, the fact that we had a stronger rupee, ever since early 2014, that only explains about 17%. It's a minority. 17% of our exports slow down. 33%, 1/3 of our export slowdown comes from weak global demand. So between currency and weak global demand, we only explain 50% of the export slowdown. Guess where the remaining 50 comes from? It comes from domestic bottlenecks. And when I say domestic bottlenecks, it's stuff like getting things from the factory to the port, the paperwork that the exporter has to do, the time taken, the complexity added. That makes our exports incrementally much more uncompetitive around the world than we actually can even imagine. And if again we can work on that, our infrastructure, our reforms and so on, we will not just revive domestic demand, but we'll also be able to make our exports much more competitive. So those people who feel that China is slowing and India will gain, to some extent, to the extent commodity prices fall, we will gain, but we have to do a lot of groundwork to be actual net gainers in this whole complexity.
I also want to talk about corporate earnings, and because that's the other big highlight in the market. When will corporate earnings come back in a meaningful way? And if you're looking at some sort of revival in commodities, because a part of the problem lies there, then do you see corporate earnings picking up? Or do you see margin expansion? So far, world over, we've seen more margin expansion and that trickling down into profits expanding. But because of sluggish demand, revenue growth is not coming. How do you look at the cycle there?
So in my view, to the core point, right, the world economy is going to expand by $5 trillion. India grew at 2% in dollar terms last year. And remember, it is a dollarized world. I mean, steel goes in, it's a global commodity. Copper goes in, it's a global commodity. Energy goes in, it's a global commodity. So in my view, India grew at 2% in dollar terms last year. This year, my expectations, it's about 10, right? As you go into that, you see the profit pools will expand with a lag. You'll see volume indicators telling you, I mean, if I look at high frequency volume indicators, which is I look at energy consumption, I look at traffic data, I look at any other data, it's telling you that things are slowly turning. It's not broad-based, it's narrow, and you expect, and you talk to CEOs, 3 months ago they said, oh,
when you're saying it's not broad-based, it's narrow, you're talking about, essentially
the number of data points that are turning and expanding fast is few, but it's slowly broadening. Okay, are you seeing 20 data indicators turning? No, you're seeing 7 turning, but you're slowly seeing there's a bottoming out in the rest of them. So as we go through the rest of the year, my expectation is that we'll see this broad basing happening, one. You'll see the profit pool expand, two, and that will translate into earnings. It will be a narrow sector initially in terms of sectors where this expands, but it'll broad base over time, and you'll see a full-blown cycle in the next 18 to 24 months is my expectation in the backdrop of what the government's been doing in terms of driving demand in a lot of different areas.
So 18 months for India you're specifically talking about. Nilesh, you want to comment on that? How do you see the cycle playing out, sector-wise also?
In my set of companies, and I quote a CRISIL report, 642 companies which declared results for March 2016, their quarterly profit, Jan to March 16, grew up by 39%.
Sure.
FY16 profit growth was 16%. So I'm happy with that profit growth. If companies give 40% profit growth, we are more than happy. So other than the private sector investment, which is a little bit behind, we have many levers working for us. So do we foresee in our segment of economy and our segment of companies profit growth of 20%? Quite likely.
Okay.
I'll just add, in the last 3 months, I met a lot of corporates in India, and 100% of them, each and every one of them have said things have improved in the last 3 months. And
what has improved? What has been their specific feedback?
Their profit margins have improved, capacity utilization is improved. Their customer demand, the kind of visibility they have has improved. And it's also in steel companies and commodity companies. So in the last 3-4 months, I think March onwards, there has been a significant, partly linked to commodity prices coming back, but partly linked to a lower base that got created in the last year. The 39% growth we are seeing is because it is over a lower base. So I think the good thing 2015 did, it also created a base for all global economies and earnings to bounce back. And at least if you go by the evidence of the last 3-4 months, and even in retail sales are starting to pick up. So you almost every company you have asked has said things have improved. They are inching up. If this maintains for another couple of quarters, then you can safely say that India, at least corporate earnings will bounce back.
Pranjul, a final round of questions on India. How do you see the trend for India? What is it that the markets are reflecting? Because over the last 2 years, I know this year may have been different in terms of the bounce back in corporate earnings, but overall, you start off the year with 15-17% estimates on corporate earnings, and then that dwindles down to 8-10%. In local currency terms, I'm talking about. How does that change for this year? What is it that the market is pricing in? And when will the market start actually reflecting that bounce back in earnings, if it is around the corner?
I mean, if I look at the last 3 months, the market is clearly telling you that earnings are going to go up, and the valuations have moved up, levels have moved up. So my sense is that the market, I mean, we could attribute it to liquidity or we could attribute it to earnings, but my sense is market is extremely positive right now in terms of what's going to happen, and they're seeing activity levels go up. My personal view is that I think there'll be a few sectors, for example, the whole construction sector, right? The EPC construction sector. If you see the level of activity over there, I think that's going to clearly see earnings over there explode. Is it going to be a 100% number or a 200% number? It could be anything. And so I just think look at certain sectors where you see big numbers coming in. There could be some sectors where there's still pain, but I think that's going to be a lag to the rest of the cycle. I mean, even to a point, even steel. I think the numbers for steel companies will also look good in the next couple of quarters.
Rakesh, coming to you, I mean, how do you really see the opportunity that there is to really cash in on that earnings cycle recovery, which we are likely to see from here?
See, if I see the last 25 years, my experience in India, there are always issues in India. There will always be something. It will be rains, it will be government, it will be budget, something or the other is there. In this 25 years, the market has gone up 35x from where it was 25 years ago. the economy has gone from a $200 billion in absolute terms to a $2.1 trillion economy. So I think India's growth is getting compounded, and we will have these episodic opportunities of global volatility, India volatility. Rains are bad, suddenly there'll be headlines out there that maybe the rains are not up to expectation. All this will create a huge amount of volatility. What I think we as investors have to keep an eye on is India going forward. And as I said, in the last at least 3-4 months, almost everything in India has improved. A lot of things the government has done, the bankruptcy code, the real estate bill, the entire Indradhanush reforms also I'm very positive about it, the Uday reforms. So a lot of the other structural problems we had in terms of administrative efficiency, even all that is starting to come back. So I think on that basis, if you take a next 3 or 5 year view, will your corporate earnings grow by 15 to 20% at least? I think it's a fairly easy assumption to make. And if it grows at that, will the markets give you equivalent kind of returns? Is what an average investor should go. And then you if you're a smart investor, you do stock picking.
But then people say that don't look at on an absolute basis, a headline, and not in terms of stock specific or the small cap, mid cap indices. Absolute basis, don't expect 15, 20 from the markets right now. If you get about between 10, 15, or even between 8 to 10, that's a good number to go by with in returns. Has there been a revision in expectations on returns?
I would say the long-term trend in India has always been about 15% or so.
Yeah.
So if you go back and see, the long-term trend is there, and that is actually very close to the corporate earnings growth rate. So if you look at the returns on the stock market and the corporate earnings growth rate, they are almost identical. So if you think corporate earnings will grow between 15 to 20% a year for the next 3 to 5 years, you might have quarterly wrinkles here and there. You should expect that kind of returns you will get from the stock market. And as all these global things are happening, I think it is only benefiting India. And it is giving another opportunity of, every time there is a global crisis, Indian markets will fall because we are interconnected in that sense. And that also becomes a very good entry opportunity for smart investors. And then if you're a stock picker, that is even better.
Would the smart investor, Nilesh, get into banks right now, PSU banks? Because if I take what Jeetu is saying is right, that there's some pain in the sector, but that's kind of getting resolved, then shouldn't this be a good time? And if we are on the brink of an earnings cycle recovery? So
today's Economic Time report says that PSU stocks have delivered, some PSU stocks have delivered 50% plus.
Yeah. Those are trading returns. I mean, time and time again, those stocks have done that.
I think again, it's not a category, it's the stock specific. All PSU banks are not same. You have to pick up those PSU banks where you think the management is doing well, the NPA recovery is possible. They have a great retail franchise, no doubt about it. But the worry is on the corporate book, and we think that full NPA is not yet disclosed. There is still some more room to disclose over there.
Okay, final word from the lady then. Is it really a case of looking at the glass half full or half empty, Pranjul? And while there might be some issues that the government needs to resolve in India, problems in specific sectors, overall, India still stands out as a very, very impressive growth story to the rest of the world.
Yeah, I agree. I think growth will remain flattish, real growth will remain flattish over 2016 and 2017, but I am getting quite, positive and excited about the medium-term outlook of the economy, and that's because I think we are finally doing some of the structural reforms which were long overdue, getting a bankruptcy code out there, which will hopefully become functional in a 3 to 5 year horizon, getting the UID bill passed, which will make many of the applications much more faster than they've been in the past, finishing out the whole, banking sector cleanup. Hopefully we get the GST bill passed in the monsoon session. All of that makes me quite excited about a 3 to 5 year horizon. But I think in the short run it'll be flattish.
All right, thank you very much all of you for joining us on this very special debate. 2016 will turn out to be a year of growth for India for sure. That's what our panelists agree upon. For the world, maybe.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.